A very good morning and warm welcome to all of you. This is Almus Market Mornings, and today we are celebrating our 1000th episode. 1000 episodes where we have brought to you all sorts of updates from the interesting world of markets. We are releasing a special video today on what it takes to do this in and out, so please do watch it in our social media space. Moving on towards the markets, yesterday the AI bubble worries seem to have been pacified with Nvidia's results. The company had strong numbers under its hood and a solid forecast. Post trade, all AI stocks had a good showing since Nvidia is the bellwether indicator for the AI industry. Dollar had a strong showing, euro comfortably below 1.16, and the yen moved beyond 155, which is quite significant. Good morning, JK. Congratulations on 1000 episodes of market coverage. But what is your sense? AI stocks seem to be chugging on, but there is a lot of fear in investors' mind. How are you reading the broader sentiment?
Good morning. Congratulations to you as well, Swaraj. It's been a pleasure bringing these updates every day, and I really enjoy doing it. Hoping to make the next 1,000 episodes and more even more powerful and adding value to all of you. Now, back to the markets. There are two events that shape the outlook for today. One is the Fed minutes that was published yesterday, which was somewhat, I would say, hawkish. Many participants suggested that under their economic outlooks, it would likely be appropriate to keep the target range unchanged for the rest of the year, pouring cold water on the expectation of a rate cut in December. Of course, many others also opined that a further downward adjustment to the target range would likely be appropriate, but they did not mention when. The indication is that in December it may not be seeing a cut, and the market has actually also uh, sized down its expectations substantially. Now we are only at 32% expectation or probability versus 95% that was seen before FOMC. And the release of minutes has, of course, not done anything that will spoil the market's party, although dollar has strengthened. The other event, as you also referred to, was Nvidia's report, which came after the US market close. The revenues came much higher, 62% year on year, and 22% quarter on quarter. Earnings were more than expected. Strong forward guidance, which is again beating expectations. The only caveat is that while results have beaten expectations, company is very highly valued, and much of the future growth is already priced in. Now, as I said, FOMC minutes were somewhat hawkish, but market is giving more weightage to the Nvidia earnings, and we have seen a big rally in the markets. US futures are showing more than 1%, in fact 1.63% up for Nasdaq futures, and S&P up 1.25% as well. Nikkei is whopping 3.65% up, and the Korea, which is a bellwether of Asian stocks of late, is 2.23% as well. And both these indices had recently corrected. Their stupendous rise in the year when Kospi has gained 80% over, and Japanese markets have gained over 50%. Uh, and of course, Indian stocks futures are also showing a positive opening. Now, while all this is happening, something significant is building on the bond market as well. The Takaichi Trade, so-called, where they have committed to spend a lot of money on the fiscal, probably going to keep the rates unchanged. Even the yen significantly weakening. All of this is pressuring the JGB yields, the Japanese government bond yields, much higher. It can force the Japanese pension funds and portfolios to start switching back to the JGBs due to attractive yield. But the real problem would be if it became unbridled, the whole lot of movement, like 10-year crossing 2% or 30-year crossing 4%, which are now already at multi-decade high, and that could actually result in a move out of the US treasuries and potentially disastrous situation for the US treasuries, where a lot of people are still getting out of the huge positions that they have. So there can be some big thing building up in the bond market. Now, what is also seen is that the dollar has significant moved over a significant point. It is now well over 100, and it has crossed also the 200-day moving average comfortably. All the major currencies are up. Dollar yen, or rather, all the major currency pairs are up, meaning the dollar is higher. Dollar yen is above 157, and so much for the talk of intervention above 155. And market uh, is probably still testing where the Bank of Japan would come in with their intervention, turning the words into actual action. But so far, the verbal statements from officials have been losing its credibility. And one wonders whether they really believe in what they are saying about yen's one way moves. So, as I said, the dollar moving significant point about 200 moving average. And if it sustains, I think by the end of the year, we could well have much higher dollar. Even as we see the sterling moving lower after a lower print on their inflation, and euro, which has been acting as a safe haven, might also weaken because now again the risk sentiment has significantly improved. Overall, we are in a risk on environment with the dollar stronger, and the stocks also going higher, set to make more gains. Bond market, of course, I mean, down the line there could be some something building up in the bond market. For the rupee, short-term bias has been shifting slightly to the stronger side, as we are seeing some intermittent flows from foreign investors, particularly for the debt market. And hedging activity from exporters have also slightly increased. Overall macros, as we have been sharing about the Indian economy, have been strong, leading to big investors calling for better performance of our markets as well. As and when that view turns into actual flows, we can expect some sustainable gains for the rupee, which still remains undervalued on RER basis. And then a combination of trade deal and improving flows will, of course, be precondition for rupee strength to, really sustain. Till then, I think we will remain in this 88.30 and 88.80 range. However, I would also like to say that while rupee may not follow the dollar index right now and may, hold its own, even if dollar index rises further, but a larger rally in the dollar beyond 101, 102 in the index, I mean, may not be ignored, as India is staring at a very large external deficit and cannot afford relatively strong currency. So that's it. We have, of course, the BLS report on unemployment in September for the US economy, but that is somewhat stale. And importantly, the October number will not be released. The November release will be only after December 16th. So we are going to have a huge gap on our view on the US economy. But in the meantime, markets seem to be quite stable. Thank you.
Thank you, JK. And of course, the theme seems to be that bond markets are under risk of getting unhinged, especially with what's happening in Japan. The Takaichi Trade, the commitment to spend a lot on the fiscal side, keeping rates unchanged, and that's pressurizing the yen, the Japanese yields, and there's a risk that these yields become unhinged, and that could result in a lot of money getting shifted, possibly out of US treasuries, and cause a broader turmoil. But apart from that, there is a good risk-on sentiment. Asian stocks having a good show today, especially after the Nvidia results. Japanese and the Korean stocks doing really well. Even US futures trading higher. Our own domestic gift nifty trading higher. And on the currency markets front, dollar index has comfortably moved above the 100 mark. Yen is moving past the 157 mark. And as JK mentioned, the verbal interventions by Japanese authorities is losing credibility. When it comes to rupee, we are seeing a tendency to appreciate. Rupee should broadly trade in the range of 88.30 and 88.80. Actual flows are waited for the sustained appreciation. That's it from us today. Thank you so much for listening. We'll catch up tomorrow with the fresh round of updates.